Have you ever felt overwhelmed by all the financial terms lenders throw at you when you're trying to get a loan? Trust me, you're not alone. When I first heard the term debt service coverage ratio, or DSCR, I thought, great, another confusing formula to memorize. But once I really understood it, I realized it's actually one of the most simplest and most powerful tools for real estate investors. Hi, I'm Kelly Arriaza, your mortgage guide to homeownership and real estate investing. Today I'm going to show you exactly what a DSCR loan is, why it matters, and how you can use it to confidently grow your real estate portfolio. My goal is to take this intimidating term and make it crystal clear. By the end of this video, you won't just understand what DSCR means, you will feel ready to talk about it with lenders and use it to your advantage. So let's get started and take the mystery out of the DSCR loan. What DSCR really is. Before we dive into strategies and numbers, let's start with the basics so you know exactly what we're talking about. Here's how I like to explain DSCR. It's basically a snapshot of your property's financial health. Lenders use the DSCR to figure out if a property can generate enough income to pay for itself. It answers one key question: can this property comfortably cover the mortgage, taxes, and insurance without you having to dip into your personal income? The formula itself is simple. You take the property's net operating income, that's the income left over after paying expenses, and divide it by the total annual debt payments. For example, if your property brings in $100,000 a year and your annual loan payments total $80,000 a year, divide that $100,000 by $80,000 and you get 1.25%. That number tells the lender for every dollar you owe, you're bringing 1.25% extra. That's like a cushion that reassures the property isn't just surviving, it's thriving. Now, while that 1.25% is often seen as a strong and ideal DSCR target, most lenders will still approve loans with a ratio of 1%, meaning the property earns just enough to cover its debt obligation. In fact, it's very common to see approvals down to 1%, and some lenders even go down to a 75%. Well-qualified borrowers are certain property types. So think of that 1.25% as a healthy benchmark, not a hard rule. Why DSCR matters to lenders? Now that you know what DSCR is, let's talk about why this number is so important to lenders. Think of DSCR as a lender's way to sizing up the risk. If you're loaning someone money, you'd want to know if they could pay you back without struggling, right? Same way, if your DSCR is above 1, it shows the property earns more than it owes, which gives the lender confidence. But if it falls below 1, that's a warning sign. It means the property isn't generating enough income to cover the debt. A strong DSCR acts like a safety net. Even if there's a slow month or an unexpected expense, the lender knows there's room to absorb it. That's the sense of stability. It's what gets your loan approved and helps secure a better term. What a good DSCR looks like. So what kind of DSCR should you aim for? Most lenders like to see a DSCR of at least 1 or higher. This tells them you have 25% more income than you need to cover the debt payments, which is a comfortable margin. It's like having a little extra room in your monthly budget. It gives you breathing space when unexpected costs pop up. For instance, if your monthly loan payment is $10,000, you'd want your property to generate at least $12,500 in net income each month to meet the 1 to 1.25% standard. The higher your DSCR is, the stronger your position will be, and that often translates into a better interest rate, longer loan terms, and overall monthly favorable financing options. How do we approve DSCRs? Now that you know the target number, let's talk about how DSCR impacts the actual loan approval process. Here's what makes the DSCR loans so powerful, especially for investors like you. Unlike traditional loans, DSCR loans don't really rely heavily on your personal income, pay stubs, or tax returns. Instead, they focus entirely on the property's income. The lender is basically asking, can this property stand on its own 2 feet? If the numbers show that the property can fully support its own debt, you're in a great position to get approved. But if the DSCR isn't strong enough, even a perfect personal credit score won't necessarily secure the loan. This approach gives the investor more flexibility and opens the doors that might otherwise be closed with conventional financing. Improving your DSCR. If your DSCR isn't quite where it needs to be, don't worry. There are ways to improve it before you apply. You can start by increasing your property's income. This might mean raising rents, improving occupancy rates, or adding services like paid parking or storage to bring in extra revenue. At the same time, look for opportunities to lower expenses. Sometimes cutting just a few unnecessary costs can significantly improve your bottom line. Another strategy is to restructure your financing. Extending the loan terms or renegotiating a lower interest rate can reduce your monthly debt, which automatically will improve your DSCR. Paying down existing debt tied to the property is also a smart move. Less debt means a higher DSCR and more attractive profile for the lender. Now here's a bonus tip. Before we wrap up, here's one simple but powerful step you can take to stay ahead of the game. Calculate your DSCR yourself. Before you apply, use accurate and current numbers for your property's income and expenses. Don't estimate or round up. If your DSCR comes out lower than you'd like, you'll know exactly what needs to work before your lender even sees it. This is a proactive approach, saves time, reduces stress, and positions you as a prepared and confident borrower. It's like studying the course before a big golf tournament. You'll know the layout and anticipate challenges and perform better when it counts. Now that you understand the DSCR and how it makes and works for you, let's bring it all together. Your debt service coverage ratio is more than just a formula. It's a key tool for proving that your property is financially strong and ready to support a loan on its own. A strong DSCR doesn't just help you get approved, it opens the door to a better rate, longer terms, and more opportunities for growth. If you're ready to take that next step in your real estate investing journey, I'd love to help. You can call or text me directly at 801-548-0162, or you can email me at kariaza@nexamortgage.com. Together we can review your numbers, explore your options, and create strategies that set you up for success. And if you found this video helpful, don't forget to like, share, or subscribe. Share it with others who are interested in real estate investing. You can also follow me on my social media at Kelly, Your Mortgage Expert. And check me out on Facebook. Have a nice day.